Hi, my name is Anya. I'm a director for Galaxy Digital. So I'm here to talk about the 3 decisions that separate tokenized projects from pilots to production. And can I get a show of hands of if anybody's involved in tokenization project, RWAs? Okay, cool, quite a few people. So my background, I've been in crypto for the last 7 years, and then the last 3 years I fully moved into the institutional space. So I spend my time speaking with asset managers and banks, and it's a very different language. It's a very different framework, because when you say crypto blockchain, half of the people in the room usually go, oh, opportunity, and the other half go risk, right? So I've learned I've trained myself to speak in a language that compliance teams at banks can understand. So if something sounds not familiar, sounds strange, just let me know. And today I really plan to talk about the 4 waves of tokenization, including real use cases of what Galaxy is doing in this space. And we've launched quite a few high-profile tokenization projects. And then the 3 decisions that separate pilots from production. So before I start, I'll give you a quick intro to Galaxy. I don't know how many people know what Galaxy Digital is. It's not a phone. Yeah, good. So we're a NASDAQ-listed, crypto-focused merchant bank. And 10 years ago, this phrase would have made no sense to anybody. But we actually here, we support the blockchain crypto industry. And we're structured like a bank, basically. So we have a lending and trading business with about 2,000 counterparties. We're the 2nd largest lender in this space after Tether. This is for people who want direct crypto exposure. And then we have the asset management business. This is for people who want exposure, but through products that we manage. So we've issued Bitcoin and Ethereum ETFs with Invesco in the States. We issued a stable coin, and we have an upcoming issuance of a tokenized money market fund with State Street. We have an investment banking arm as well, where we support companies with fundraising, with mergers, acquisitions. And then we also have an infrastructure team. So I sit on the infrastructure team, and that supports things like key management, custody, tokenization, staking. So this is the digital asset portion of the business. And then we have the data center portion of the business, which is basically we've converted our Bitcoin mining facilities into data centers, because we've seen a lot of growth there where we're providing compute and energy. So this is what Galaxy is. And I'll talk about the 4 waves of tokenization, which of course starts with stablecoins. I mean, it's a huge market now. I think most people here know 300 billion, really dominated by Tether USDC. And this market got so huge, not because it's crypto for people who don't like making money, but because it solved 3 major problems. So the first problem is, of course, cross-border payments. So anybody who wants to move money on the spot, on the weekends, they wanted to pay their suppliers overseas. It solved that problem. Second problem it solved was really access to US dollar in countries with comparatively weaker currency. And that's still obviously a really big use case that sometimes people in Western world don't think about. And then the third problem it solved was just a trading pair to crypto, basically. Whatever you do, Bitcoin, Ethereum, Solana, you can use stables for that. So because it really landed that product market fit, we've seen a lot of scale, a lot of traction. It's only, we just hear announcements about new coins launching all the time. So we've actually also launched a Euro stablecoin. So it's a MiCA compliant, BaFin-regulated coin called Euro, All Unity Euro AU. So we've done that together with DWS, which is an asset manager for Deutsche Bank, who's the issuer and the reserve manager, Flow Traders, who do the market making, and we provide the infrastructure. So you can see how we partner. It's not just about, here's another coin. We really want to set it up for success. We really think in Europe there will eventually be a successful Euro stablecoin, so we're well set up for that. And then the second wave of tokenization is kind of answers the natural question from the first, right? Now that you have cash on chain, which is what stablecoins are, you want that cash to be able to generate yield. So this is where the tokenized money market funds came about, or tokenized treasuries. And there is about 30 of them now globally. So the most recent one was Fidelity that launched at the end of last year. And the one that we are launching with State Street is coming up very shortly. So the exciting thing about it is that you'd be able to do subscriptions, redemptions in 24/7 using stables. So in this case, it would be PayPal USD. And it really opens up an opportunity for people to manage their cash entirely on chain. And the cool thing about, like, sometimes I get asked by asset managers, banks, well, is there really any money in it? And well, I think if you just look at BIDL, for example, right, the BlackRock tokenized MMF, it's they're charging 50 basis points for it, right, which is about 5 times more than their normal money market fund, which is very interesting. It means that people, like a lot of people, are prepared to pay 5 times more for the same exact economical product that's just on better rails, right, that's just on chain. And they're prepared to pay more because it fits into their ecosystem that they use. They don't want to go off-chain, on-chain. You know, it could be treasuries of large foundations, could be corporates, whatever that is. People want to stay on-chain. BIDL is now over $2 trillion. Sorry, 2 billion. And I mean, you can see that there is product market fit. There's going to be more tokenized money market funds coming online, I think, this whole year. And then the third wave of tokenization is answering yet another question, right? So stablecoins answered the question of how do we move cash on chain. Tokenized money market funds answered the question of how do we have yield on chain. And now we have a question, how do we do financing on chain? I mean, in a traditional sense, right? RWAs, which is a tokenized debt. I think tokenized debt is a huge next wave. Well, it's already here, and it's only going to grow this year. So one of the main things that we've done in this space is we've issued a tokenized CLO. So it's a collateralized loan obligation. It's a very cool product because both the underlying assets and the tranches on debt are on chain, which means people that are buying that token, they can plug it into the dashboard that we have built, and they can in real time assess the risk of the underlying holdings, which gives unprecedented level of transparency, really, that hasn't existed in the space. And I don't know if you've been following what's going on with private credit right now. There is a lot of issues, you know, mismatch of liquidity because people are unsure, valuations are hard, it creates a little bit of fear. So tokenization really has a way of solving it, not the whole problem, not the hard to price problem, but it has an ability to provide more accurate data and more liquidity for tokenized debt. And then the fourth major wave of tokenization that's coming is, of course, tokenized equities. They are a lot more complex. There is a lot of, you know, questions around ownership, corporate action, governance. So it's really solving ownership on chain. And I don't know if you know, but when you buy a share, an equity through a retail app, you could be going through up to 7 or 12 intermediaries. So tokenization is not going to remove all of them, but it's going to compress some of them. So for example, and also tokenized equities, right? It's not like people say with tokenized equities, but it could mean very different things. And the way that it has been done is somebody might set up an SPV, special purpose vehicle, buy a bunch of shares without necessarily letting an issuer know that they're doing that, put those shares in that SPV, and then sell tokens that represent the beneficial ownership of the share. So it actually increases the number of intermediaries, and it does not give you direct ownership. So this is why we've decided to do something very different with our NASDAQ shares. We were the first to natively issue them on NASDAQ, together with Superstate, who is the digital transfer agent, which means that we've reduced the number of intermediaries, and more importantly, it means that if you, well, the regulator likes us, that's another thing, and then if you hold in that token, you actually have the same exact rights as anybody who's holding our share in a traditional paper format. So I think it was a very slow, difficult process, but the advantage is once you land on the right model, and this is the right model, I believe it will really scale. So these were the 4 major waves of tokenization. And now I want to talk to you about the 3 decisions that separate pilots from production in this space. So the first decision is about control, the second about custody, and the third about connection. So it's control, custody, and connection. And control is really about who owns and who controls the asset. So it's the whole value chain. It's all the players that are in place to manage let's say when you buy an equity, you might have the actual broker dealer, then you might have your the exchange or a market maker that's executing the order. You might have a transfer agent, then you might have a settlement agent, a depository. So you need to understand what step is controlled by what entity. And then you also need to understand things like how subscriptions and redemptions work, for example. So this is all about the governance side of things. And the exciting thing about blockchain, which it enables, and I'm sure most of you here understand it, but I find that I have to sometimes explain it to people, is that it's a unique asset that combines both information and means of payment. So for example, when I'm making a bet on Red Sox winning a game, and I know I don't look like a baseball fan, and I'm not, some color socks, right? How would I normally do that? I would put money in escrow, then once the winner is determined, the third party would pay those money to the party that won the bet, right? So you don't need to do that in blockchain. You can just lock the money in the smart contract that also has an oracle that then receives that information, auto-executes, and makes the payment. So it's a very simple example, but it just means that a lot of those flows that we see in traditional finance can be simplified because information and means of payment live in the same place. The second decision is really about custody. So of course, people often think about custody of crypto assets, but it's also custody of the traditional assets. Sometimes the difficulty, like I talk to asset managers who are thinking about issuing money market funds, and they go, well, can you do atomic settlement 24/7? And I'm like, well, the technology certainly can. So it's really not about the tokens. It's really more about, can you get access to cash in 24/7 to make sure you meet your subscriptions and redemptions. So it's the custody of both sides of the equation. And it's also not just the key that holds the asset, which is, of course, everyone understands is critical, but it's the key that manages the smart contract. And last week, we've had the issue with Resolve, a stable coin, which lost 70% of its value after a hacker was able to get to that private key and basically mint 80 million of unbacked tokens, right? And get away with 20 million worth of value. And I think getting away with 20 million worth of value is actually less scary than the fact that they were able to mint unbacked tokens. So for somebody like a bank who's issuing a fund, that would violate all of their compliance obligations, right? That would be like the end of that project, massive reputational risk. So that's the second decision, that's on custody. And the third decision is really on connection. And connection in this case means connectivity into institutional DeFi and into the broader ecosystem of participants. Because of course, the really cool thing, we have BUIDL that pays yield, but now you have a yield-bearing instrument. Can you also use it as collateral somewhere, right? And you can now, which is super exciting. So it's really thinking through about what you want the asset to enable. Do you just want the copy of the traditional asset but on chain, which we already seen is still valuable and there is very much a demand for it? Or do you want it to also have some unique features that allow you to use it in DeFi, for example? So I'll just leave you with that, the 4 waves of tokenization, the 3 decisions. And if you have any questions on what Galaxy is doing in the space, please come and say hi.